Hey, welcome to another edition of American Dreamin. This is episode 6, and I'm Jeff Tufford, your host, owner of Epic Mortgage Group in Grand Blanc. Today we're joined by Allison Johnston. She's the president of Success Mortgage Partners. Also, Peter Loftus from Credit Plus, and Kevin Broughton, who's executive vice president of Success Mortgage Partners.
All right, Kevin, why don't you tell us a little bit about your role at Success Mortgage Partners?
Thank you, Jeff. I appreciate it. Thanks for having me on tonight. My title is the Executive Vice President of Recruitment and Retainment. And what I do basically all day is I recruit loan originators from other companies to Success Mortgage Partners. And I spend a lot of time with our existing salespeople trying to help them be more innovative, more creative, and sell more mortgages. So that's what I spend almost all of my time doing on a daily basis.
Okay, perfect. And if you don't know, Success Mortgage Partners is the parent company of my company, Epic Mortgage. And so Kevin recruited me. So he does a good job.
I did. That was a long time ago, coming up on 7 years, right?
Yeah, I was 10 years in one spot. And so it wasn't easy to pry me away, but it's been good. So Peter, why don't you tell us what you do over there at Credit Plus?
Credit Plus provides credit data and verification services for the mortgage industry. We are the third largest in the country. We're based in Maryland, but we have reps in every single state, including Alaska and Hawaii. So we provide credit data to mortgage brokers, bankers, credit unions. We also do some commercial credit reports as well, providing tri-merge credit reports and interfaces with loan origination software.
All right, perfect. That's very useful part of what we do. We have to have that, obviously, to grant credit decisions. And so some of the stuff they do is very innovative, and it helps us out a lot. It's not just a standard, here's a credit report, but we do a lot of credit, and be compliant. Credit coaching, maybe is a good word, or we can get a lot of information from Credit Plus as to what someone can do to improve their score, and it works out really well. It's very advantageous for us to have. So thanks for being on, Peter. Allison, tell us about what your role is as the recently crowned president. Now it's been about 6 months, but of Success Mortgage.
Hi, everyone. So my job is really to help run the day-to-day, work with our managers, make sure that everybody has the tools that they need to be successful, take the loan from application all the way to the end of it, and make sure we do it compliantly.
You forgot one part. Fix Jeff Tufford's problems.
Woohoo! Yes.
Yeah.
Those Epic mortgage loans. Yeah.
Allison, the underwriters being unreasonable. Fix it. Something like that.
All right. And my response is always on it.
Right, exactly. So we'll start with you as far as questions go. Big thing right now that I'm thinking of, and I got a video that I was trying to shoot today to give more insight, but had some technical difficulties. So I'll get that out. But big thing we're hearing about right now is basically, especially, we just had the first of the month. We're in a lot of mortgage payments were due. And so forbearance is a hot topic right now. It just sounds amazing that people are offered that they can skip a payment for 6 months or for 180 days and then potentially get another 180 days. And all they have to do is say the magic words, I have a financial hardship because of the COVID-19 situation, and no paperwork or anything. So how does that affect our market and the companies involved, and the government decides for all these companies who collect payments and things like that they don't get to collect payments for a while?
Yep. So you're absolutely right. Forbearance is a big topic right now. We had 17 million people in the last 3 weeks filed for unemployment. So what happens in the market is if the president has declared that it's considered a disaster for COVID-19, then borrowers can skip a payment. There's a couple things that go with that. One, there's always consequences with that. The credit report will either say forbearance or maybe affected by a natural disaster, and that will affect the borrowers because any loan that's currently in forbearance or delaying any payments is ineligible to do any type of refi or potentially purchase another home. It can affect the credit score, and there are some rumors that if they don't make their payment, then when they are able to make their payment, they might have to make 3 or 4 payments right away on a lump sum. So this does affect our business because there are certain programs where we have servicers that have to make the payment on behalf of the borrower. So we sell to these agencies, there's Ginnie Mae, which is on the FHA side. And if the borrower doesn't make the payment, the servicer still has to make the payment to Ginnie Mae, which is causing a whole bunch of different things happening in the market, which is causing programs to constrict with FICO scores and DTI, because a lot of servicers are worried that if the borrowers can't make the payment, then they have to make it on behalf of the borrower.
Okay, so what you're saying is basically if we have investor A or lender A, whatever you want to call them, and then we don't do it. So let's just say Mortgage Servicers USA is collecting a payment from John Doe, and John says, I need a waiver on that, or I need a forbearance. To say, sure, you have it. But then that servicer, Mortgage Servicers USA, has to still send the mortgage company the payment. And one thing that I've heard as well is, and obviously we kind of know this, taxes aren't going to stop and insurance isn't going to stop.
That's correct.
You still have to pay all your escrow stuff out as well. And a lot of my clients, when we're trying to refinance them, have talked about their escrows are off, or I'll look at it and I'll say, "Ooh,
yep,
your escrows, if you don't do anything, are going to get jacked up." So in this situation, it's going to be really bad on the escrow accounts, right? Because they're going to be way behind on collecting taxes and all that stuff. It's going to cause a lot of ripples, I would say.
And it's going to affect their FICO score. So it will affect their credit score when it's all said and done.
All right. Well, Peter, speaking of that, how does having something like the words, because people don't realize it's not just a payment history on a credit report, right? It's when they open the account, the last activity, you got the payment history, but you also have kind of coded words, like you could get, even if you have a foreclosure, sure, the payments show all super late, but then it has that word foreclosure on there, and that affects your score, right? So would forbearance be the same way?
So the way we understand it, and apparently the environment is still changing, and we're not really exactly sure, but from a credit perspective, what we are hearing is if the lender codes that particular trade line that they're reporting to the bureaus, the codes are AW or CD, and Allison probably could explain what those codes mean more in detail. But because she had mentioned, did I lose you?
No, we're good.
Okay.
Now we did lose. Oh, there you are.
As long as that code is accompanied with the data that gets reported on a monthly basis, then it will be in forbearance. And lates will not be recorded on a credit report and will not impact FICO scores as long as it's coded properly. Now, our big concern is everyone going to be coding it properly? Are servicers going to be coding these properly? We haven't had a real definitive answer on who's going to do what. So I guess in the next 30 to 60 days, we're going to start seeing who's coding these properly and who is not.
Mm-hmm.
So in the past, I've seen where there's missing information and there are X's where the payment where it should be a 1 for an on-time payment or a 2 for 3. We've seen X's. Is that something when you look at the last 12 months, you might see on time, and then 6 X's and then?
Yeah, and that goes back to trended data. So the mortgage industry started trended data over a year ago of tracking how consumers are making payments. Again, it's not real clear at this point in the game of how that's going to be recorded with X's or 1s or dashes. We're not really sure on how the bureaus are going to be recording that data.
Okay, so Allison, is there any foresight onto, like, when we do a mortgage, sometimes we have to have the last 12 months of on-time payments on certain mortgages where they look back and they see if you have rent or you have a mortgage. They look at the last 12 months. Our underwriters have to look at that. And what do we do? And is there any kind of idea what's going to happen when you look at the last 12 months and you see 6 X's and you reach out to the servicer and say, okay, give us a payment history, and there's 6 non-payments? I mean, the government's saying they can't say late payment on credit, but it doesn't say what the next mortgage company or the next creditor, how we have to view these skipped payments. Like, they're not saying that Success Mortgage or another mortgage company doesn't look at that and say, yep, we can't help you because you had this forbearance in the last 12 months. Is there any idea what's going to happen with that?
No, and what's crazy is the only stance that they've taken is if they're currently in forbearance, it's not eligible for a new loan to be sold to certain investors. So they haven't been able to say, okay, let's say they did have a hardship and they did have to defer some payments or have forbearance. There's zero guidance right now that says how long they have to have on-time payments for. So for example, there's nothing that says, okay, they had a hardship, they missed some payments, now they've made 6 to 12 payments on time. Not any direction has come from that yet because it's still so new. And Peter has a great point. If they code it correctly, we have seen borrowers that have inquired about deferment or forbearance, and they've already hit their credit card or their credit report for forbearance before they've even missed a payment.
Yeah. And let me jump in there for a second and follow up with Allison's point. So oftentimes we will get requests for supplements. So if there's a mortgage reporting and the lender, like Mortgage One or Success Mortgage Partners, they want to know when the last payment was made.
Right.
When that is in forbearance, at this point, our legal team is telling us that the only thing that we can give them is it's in forbearance or it is not in forbearance. We are not allowed to say when the next payment is due or if it's late or whatever that situation is. All we're going to be able to report is if it's in or if it's not in forbearance.
Yep. And then Jeff, one thing that we're going to be doing is you got to look at the payoff. You have to determine if the mortgage statement to try to figure out how far they are behind.
Right. And there's a lot of, I think some of our refinance programs will only let you be so far behind. And it's not that you're behind, you're late, but they'll say you can only roll in, the interest for 1 month. So you
Right.
could skip the payment and still have another payment coming due. So that, I think that could be a problem. If someone's out of their forbearance and they make one payment and then they want to refi, that payoff might show that there's 5 months of interest added on to the principal. So
Right.
that could be so basically what we're saying, guys, is we don't really know. I mean, so
There's really not a lot of guidance that's been published yet just because it's so new.
right. And the government's saying you can't report it late. Peter's company, won't be able to get information from the creditor showing it's late. Then that still doesn't tell us what to do on the next side, on the next application, on the next attempt to do something. Like, no one's telling us we can't look at it as a late. So, I mean, of course, and we're not the ones who ultimately make the guidelines. It's FHA and Fannie Mae and all these. And sometimes, as we saw with VA, Ginnie Mae makes a rule, and it doesn't matter what VA's rule is. Ginnie Mae's buying 80% of those loans, so they make the rule. So, Kevin, this all sounds kind of bad. So you got people who might be in a position where they're like, I don't know, I could use this. Maybe I don't have to have it. Maybe I'm not going to starve if I don't do a forbearance, but I could use this. And now maybe they're hearing this thinking maybe I shouldn't. And then you got people who are off work. I mean, what are your thoughts on, you're really good with our team and everybody with perspective and motivation and keeping in the right mindset. What do you think about all this?
I think it's obviously difficult times, Jeff, and we're seeing things unprecedented in the past 4 weeks. You and I have both been doing this business for, I've been north of 24 years. You've been in this 20 years, and it's unlike anything we've ever seen. We both lived through the Great Recession in 2008 and 9, and this actually even feels a little different. Some of the changes that have impacted the mortgage industry have been so sweeping and so quick to come to fruition that it's difficult to get your arms around all of them and to see what the greater impact is. Obviously, the federal government stepping up to assist Americans who have been impacted by the COVID-19 reality is great, and it's serious, and it's exactly what the government should do. My general opinion is if you can afford to make your payment, make your payment. And yet there is a safety net there for those that can't. I think that you and I have talked so many times over the years, and difficult times often produce very difficult realities, right? And so we're in a world that no one could see coming. We didn't think a month ago that we might wake up and have to be quarantined in our home. I'm on day 27, where I have not had any outside contact with anyone other than my wife and child. And that's not me. I'm a sales guy, and I like to be out and about. But we're all doing the right things. We're trying to do everything that they talked about in flattening the curve, and it appears as of today that we're starting to see some benefits of that. But in regards to the government intervention, I think it's great that they stepped up. I think it's great that they're getting money into all the millions of Americans who, through no fault of their own, are unemployed. And I would just say that if you're in a position to make your mortgage payment on time, there is no free lunch, is what we've learned in our industry over the years, right? And this isn't going to be hallelujah, praise the Lord, I don't have to make my mortgage payment, and there's no ramifications to that. I think, as Allison and Peter were just discussing, and you were just discussing, what the ramifications actually are and the long-term unintended consequences of the help is yet to be seen, right? So it's always the safest and most prudent path to make the payment if you can. But if you can't, that's what the government has stepped in to assist with. So that's kind of my take on it.
Kevin, let me ask you a question, because I guess I'm a little confused as well. So there are lenders, and then there are servicers.
Correct.
I think that servicers will recognize a forbearance for 90 days, but after that forbearance, they are going to request payment in full, or they're going to start foreclosure proceedings, where a lender can say, I'm going to put this at the end of the loan. What am I missing on that?
It's a great question, Peter. And again, I believe it's a gray area, and I'm not an expert, but I will tell you this, that this goes directly to what I believe is probably the most serious and major impact currently occurring in the United States on the mortgage industry. And so many government loans, a large percentage, I don't have the exact number, Allison, you may, but I believe it's over 50% of the government loans are serviced by non-bank Ginnie Mae servicers. And what that means is obviously what it says. It's non-depository banks. So it's mortgage entities like ours. We don't happen to be a Ginnie Mae servicer, but we know many, many people that are. And those people owe the payment to Ginnie Mae whether or not the payment is made by the borrower. So if you happen to have a $5 billion Ginnie Mae servicing portfolio, and none of the people make their mortgage payment, you as the servicer owe the payment to Ginnie Mae. That could be $25 million a month on a $5 billion portfolio. And if you buy a Ginnie Mae bond, you are guaranteed your payment by the full faith and credit of the United States federal government. And that's why these non-bank servicers and bank servicers must make the payment to Ginnie Mae, because the bondholders guaranteed their money, whether or not the borrower pays their mortgage payment. So correct. Imagine if you are a non-bank Ginnie Mae servicer and you have every mortgage payment due on April 30th and none of the people make their payment to you. You still owe 100% of the money. And on the day they passed the stimulus package 2.5 weeks ago, there was no availability to what's called a liquidity pool for the non-bank Ginnie Mae servicers to go get money to make that payment, and yet the payment is due. So that is a very serious situation impacting the mortgage business now. I read a great Bloomberg article on this about 8 days ago, and I think the name of the article, or somewhere in the title of the article, was "The Next Mortgage Implosion." And that's a serious issue. So, Peter, I don't know every single detail and every nook and cranny of how that will be viewed, but I do know that the servicer is going to make the payment to Ginnie Mae.
Yeah. Allison, didn't a group of the servicers request the federal government to open up some liquidity?
Actually, I could speak to that, Jeff. They immediately went to ask that, literally the day that the stimulus bill was passed. And at first, I'm pretty certain that the federal government said, no, we're not going to do that. I believe that they have changed that, and effective within the last 48 hours, I think that they have made or in the process of making available a liquidity pool, but I don't think it's been fully explained as to every detail of that, because someone's going to have to borrow significant hundreds of millions of dollars. And again, there's no free lunch. So that servicer, I'm sure, is going to have some realities of that liquidity pool that aren't just free, and there'll be ripple effects and long-lasting implications from this. I believe 100% for years to come.
Okay, so let's give an example of this, because I know that someone on our team, well, not mine, but at corporate, or we call it corporate, they want us to call it home office, right, Allison?
Home office.
At the home office, was offered a forbearance, and it went something like this, and my numbers aren't going to be 100% accurate, but you have a $1,300 mortgage payment. We can give you 6 months without having to make that payment. Well, okay, then what? Well, then after that 6 months, you will get your $1,300 bill for that 7th month, plus you'll get a $7,800 added on to that for the 6 you skipped. Right. Whoa, if I don't have the money to pay it now, what makes you think I'm going to have all the money in 6 months? Well, don't worry, Mr. Borrower, Mrs. Borrower, we can take that and spread it out over 12 months. So, okay, so my $1,300 payment becomes $2,600 for the next 12 months after that. Yes, isn't that great? And that's not really great for most people, is it?
It's not. And the problem is, since there's no real clear direction, every servicer is doing it a little bit different on how they're going to collect the payments. Your example was, 6 months. I've heard that some of that money is due in 3 months. They're only going to give them 3 months. And so without the clear direction of exactly how it's supposed to happen, I think servicers are making up, what they need for their company, because there's no direction for them to follow exactly how it needs. Just like Peter said, they should be reporting it, but we don't know if all servicers are going to report it right or not. So until some clear direction comes down from the government on how these should be handled, you're absolutely right, Jeff. That's not a great deal for some people.
Right. And as you probably know, I'm sure most people might not know, though, that the government stimulus package only covered the government loans, right? So you've got Fannie Mae, Freddie Mac, Rural Development, or USDA, and FHA, and VA. But if you have a loan that's not, sometimes you could do a conventional loan, it just doesn't get sold to Fannie Mae. So even though it's by the book, by Fannie Mae's guidelines, it's not a Fannie Mae loan, and your servicer doesn't have to not report you late in that case. Isn't that right, Peter? Like, the government loans are the ones that are under this rule where they say no late payments can be reported, but an outside non-government loan, we might see late payments on the credit for someone like that, right?
That could happen. Yes, that could. Yes, it could.
So yep. It's very, very scary proposition to take that. I've had a couple clients that have told me they asked for it just so that they could be told yes, but they're still making their payment on time just in case, which I'm kind of thinking, what's the rush? I mean, you can ask for it when you need it. You don't have to ask for it when you don't need it, but they wanted to have that, I guess, already in place in case, but we just don't know is basically the end result of this whole thing. And so, Allison, what do you think could happen to the whole industry if just way more people than they expected take them up on this offer? A lot of people who don't need it.
It's going to be an issue. It's going to be an issue for the market. It's going to be an issue for the servicers. And I think one thing to keep in mind, the individuals that you were talking about that had it and made the call, their credit report, if it says forbearance or CD or AW, we cannot refinance that loan. Fannie Mae has come out and said if a loan is in forbearance, it's not eligible for a refinance. So we have great interest rates right now, and I don't think people realize it's going to affect their opportunity to be able to get that low interest rate, even by them just calling and it getting marked on their credit report. And then what do? Then you try to call and try to get it removed. How long does that take to happen? So I think Kevin summed it up the best. If people need it, I think it's great that the government stepped in to help. But if they don't need it and they want to benefit from the lower interest rates, then they shouldn't call their servicer to get it.
Right. I feel like we could have some problem with liquidity to write new loans if enough
Absolutely.
happens on the backside. The front side is going to be affected.
Absolutely. And requirements could be changing for lending as well. on what credit scores will be acceptable going forward, what kind of back end ratio, those type of things are going to be affected if that continues to happen.
Kevin, how important is the mortgage industry and the real estate market in general for our economy? And because you've been on both sides, real estate, you've been in mortgages now for a while. So
I think it's invaluable. I think as we come out of this hugely unfortunate situation, as Americans get back to work, we can't lose sight of a couple things. And first being that this is a temporary situation. And God bless everyone who's been impacted by it. It's terrible for the health of people that have been impacted by this. It's horrible. But as we get back to quote unquote normal life, we can't lose sight of the fact that 4 weeks ago, we were living in the greatest economy in the history of the United States. We had the lowest unemployment in 50 plus years. We had the highest stock market reality ever seen in the history of the United States. We were in the most booming economy. We're going to return to that because as Americans, you know what we are. We're resilient, we're fighters, and we're going to come out of this thing stronger, and we're going to return to the economy. And a huge part of that economy is the mortgage, finance, and real estate sector. And the United States government, I will bet anyone a lot of money that they want consumer confidence to be as high as humanly possible in those regards. I think we're in for a record low interest rate environment that I believe is going to last potentially years, not months or weeks. And I think that is a great thing for the American public. I think we're going to see so many people have a bit of a pent up demand to get out there and start living their life again. And after doing the right thing, you know, for my family and me, quarantining has been the right thing in our opinion. But I want to get out. I want to get out and do stuff. You know, I still have the same amount of money in my wallet that I did 27 days ago because I don't have anywhere to spend anything, you know? And
I think
so
the longest lines are going to be at the barber shop and the salon, man.
oh
I'm
gosh,
sure.
I need the barbershop in the worst way. Yeah. But Jeff, to your point, I believe that the vitality of the mortgage and real estate markets is of monumental importance to the United States. I think we're going to see consumer confidence soar in those areas very soon. And I think we're going to be in for a very nice run in our industries with low interest rates. And I think that you'll see a lot of home sales. I think we're going to return to the economy that we were all experiencing literally 30 days ago.
Perfect. I agree. I think that we are going to have a lot of pent-up demand. So I've been telling people you should get pre-approved now so that you're first in line when they say, okay, you can look at houses again. You can schedule your appointments and get out there and be ready to put an offer in as soon as possible. And those sellers who've been waiting to be able to sell their house want to get that good offer and find a deal and get moving on it.
Absolutely.
All right. So we're about up on our time. I'll see if you guys have any extra or any final words or questions. We'll start with you, Peter.
No, you know, my mantra has always been open, active, responsible credit, and that should not change in the way we're doing business now. Making your payments, being responsible with credit limits, and keeping and maintaining credit trade lines.
Okay, I do have one more question for you. Have you heard about credit card companies and other institutions, non-mortgage related, doing something similar with forbearance?
I have not. That's something that we did talk about recently on our national call, and we have not. They have not really said anything yet. We're waiting for that shoe to fall. So
well, it'll be the same situation, right? With a lot of unknowns.
Correct.
Okay, Allison, final thoughts, questions?
We're excited to get things back to normal too. I know a lot of us are working out of our house, 5 kids, 2 dogs, 1 cat. I just need a partridge in a pear tree. So we're excited to get back to normalcy for sure.
Hey, we've got 5 kids too. And the difference is some of my kids can't feed or clothe themselves.
Listen, so, just because mine are in their 20s doesn't mean they can either.
Kevin, can you give us some final thoughts, including something positive to take away here?
Sure. Hey, thanks so much for having me on, and thanks for doing this. I've always admired you, and I've always looked up to you as someone that I respect in the business and who I always feel is like a compass in a rough storm. I always think that you're a guy that tries to take the emotion out of things and make good, rash decisions. And I've always valued our friendship, and I've always admired how you are. I've been through tough times before many times, not just the recession of '08, but many times. And what I've found in tough times, Jeff, is typically people do one of three things. They either fight or they freeze or they flee. And I thought about that today, like in our industry. We're going to see 20% of the people flee out of the market. They're just not going to do the job that we have anymore. You're going to see about 7 out of 10 just freeze and do nothing for the next couple of months or month or whatever it's going to be. And then you're going to see 10% fight. And I know you're always in that 10%. Allison's always in that 10%. Peter's always in that 10%. And I try anytime in times of adversity to be in that 10% too. And I think what you'll notice if you look out a year from today, those that fought, where they're going to be in relation to those who froze or fled is not going to be a tiny bit above. It's going to be exponentially greater. So fight. If you're in sales, fight, educate, console, call, train, help, advise, do anything you can. If you're in sales like you are, Jeff, contact your whole database, call them and see how they're doing. Be nice, be there, be present, do the things that we all need to do to continuously build our businesses. Have that others first mindset every single day, right? Get up earlier, have a routine. Just because you're I hate working out of my house personally, but I get up as if I'm still going to work. I take a shower, I get ready, I get at a desk, I think about it, I have my journal, I write in my journal every morning. You know, I look at my quotes that I have written down that I put over the years in there. I look at the ones that revolve around tough times, and I go at it every day. I'm working as hard today as I did before this thing, and just fight through tough times and be there for other people, and you'll come out on top. So thank you for your friendship and for including me in this opportunity. I appreciate it.
All right, thank you for coming, and thank you too as well, Allison and Peter. You guys are awesome and definitely experts in your field. And anything that anybody needs, you can reach out to me, and I can connect you with Peter if you have some credit questions. Actually, that's a bad idea, right, Peter? Everybody that watches videos call him Peter. Peter, I want to get my credit score up. So call us, we'll help you, and Peter will help us. How about that?
That's right.
Yeah, there you go.
Perfect.
All right. Well, thank you guys, and everyone out there, stay safe, and make good decisions. If you don't have to do something that could affect you negatively down the road, please try not to. So I've always said you could try to put off your utilities first, your internet, your cable, your things like that. You could put off your car insurance, make your mortgage payment first. All right. Thanks, guys.
All right.
Thank you.
Thanks, Jeff. Thanks, guys. Take care.